To remain updated with the latest business news, click on the bell icon.
Well, it's just a matter of time and we will see the union budget getting presented by Finance Minister Nirmala Sitharaman, and we'll get to know whether this economy will get the booster dose that it requires to get the economy back on track and to progress on the path of growth as well. Joining in to discuss what can we really expect from this upcoming union budget, I have with me a very special guest joining in. Mr. Sajid Chenoy, Chief India Economist at JP Morgan India, joins right in. Thank you so much, Mr. Chenoy, for taking out time. I want to begin by asking you, what are you really expecting from this union budget of 2022-2023? Will it really provide the booster dose to the Indian economy that it needs right now?
The encouraging news is the level of activity is now back at the pre-pandemic level. So we're close to a little ahead of where we were back in March of 2020. But really the next aspiration has to be, how do we go back to the pre-pandemic path? Where would India have been absent a pandemic? How far are we from that? And how quickly can we get back to that path? And I think this is where a fiscal policy has a role to play. And I would expect that the budget would provide support to close that gap with the pre-pandemic path. Now, a year ago, Siddharth, the intellectual consensus was clear. All countries were just emerging from the pandemic, so there was an open license for fiscal policy to be very expansive. And we saw that in last year's budget with a big push on capital expenditure. There's also a budget which was very well received because of much greater realism on tax revenues and much more transparency. This year, it'll be a slightly more delicate balancing act because on the one hand, I would hope to see more capital expenditure, more infrastructure spending, more health and education spending to help the economy. But the global backdrop has become less benign. Oil prices are close to $90 a barrel. And because of the Fed, global financial conditions have tightened. So the balancing act this year will be, how do you provide near-term support to help the recovery and help jobs in particular? At the same time, reaffirm a credible medium-term consolidation path to preserve macroeconomic stability.
Mr. Chenoy, jobs have been a clear pain point for this government. Do you expect this budget to really address the issue of job creation?
Job creation is an issue all around the world. Coming out of a pandemic, even the US, we still have about 3.5 million fewer jobs compared to where it was before the pandemic. Jobs are certainly a challenge in emerging markets and in India. And I think this is happening for a couple of reasons. One is, in many parts of the world, the pandemic has accelerated the transition from the informal economy to the formal economy, which tends to be more capital intensive and less labor intensive. So you can produce the same output with fewer jobs. The second is, because of this transition from informal to formal, you may have a skills mismatch opening up. So there's excess labor in the informal sector, but the formal economy is growing. They want a certain kind of worker, and sometimes that skill type is not available. So this is both an issue of creating enough jobs, but also of ensuring that the skill mismatch is mitigated. Now, what can the government do? My sense consistently for the last couple of years has been, job creation is not easy, but what we can do is public investment. And I think this has been the government's focus. We saw in the pandemic year a capital investment. So if we look at capital expenditure in the budget, rose from about 1.6% to 2.1%. The target was even higher in this fiscal year that's ending, and I hope the government can meet that target and set higher targets next year. So I think the near-term focus has to be, if there is more spending on infrastructure projects, on health, on education, that will create jobs. The second advantage of that is if you have a sustained public investment push, right? Hopefully over time that will crowd in private investment, and then private investment will create jobs. So this is going to take some time, but I think the budget has to be a catalyst for a big sustained infrastructure push for job creation.
Well, another big concern that most economists are talking about right now is the lagging consumption. How do you expect this union budget of 2023 to really address consumption, push consumption at this point in time, at the same time, balance it, keeping in mind the inflationary pressures?
That consumption is taking some time to recover precisely because of what we just discussed in terms of job creation. So in the US, what you're seeing is there are large excess savings that households are sitting on, 2.5 trillion. And so even if everybody isn't fully employed, temporarily you can support consumption by running down those excess savings. Now, emerging markets in India don't have the luxury of all that excess saving. Any excess saving that exists today is lying with corporates, not with households. So in my mind, job creation, job certainty, future income certainty will have to be a prerequisite to jumpstarting private consumption. What can the budget do? I think the budget can and should focus on particular vulnerable areas. I think certainly, for example, and help certain pockets of the economy in the informal sector, SMEs that may help. But I come back to the larger point that the best way to drive sustainable private consumption is through job creation. So to the extent that the budget can jumpstart a cycle of job creation, that is, I think, the best prerequisite to preserving medium-term consumption growth.
I also wanted your word on the fiscal position that we have. Should we begin fiscal consolidation at this point? Where do you stand right now?
I think it's a matter of degree. I think nobody doubts that, that given the starting points where we would expect this year's fiscal deficit to be around 6.8% or slightly lower, perhaps closer to 6.5%, given that the states are at 3.5%, the total public sector borrowing is still about 11% of GDP. So off that starting point, particularly against the backdrop of what's happening globally, emerging markets will have to demonstrate some fiscal consolidation. I would argue we should not overdo that fiscal consolidation. So in my mind, 0.5% of GDP consolidation for the next year would provide a good balance between creating space for supporting the economy in the near term and yet signaling a desire to reduce the deficit in the medium term. So ideally, what we should want to see is a gradual consolidation this year, but a very credible consolidation in the roadmap, so that foreign investors, ratings agencies can take comfort that over the next 3-4 years, as India's economy continues to recover, the deficit will be brought down. Ultimately, we're in a world where what will matter is debt sustainability, right? Debt to GDP. And India's goal, like that of other emerging markets, will be to sustain debt to GDP and stabilize it at current levels, not let it keep rising after the pandemic. Given our starting points, what's interesting is what really matters for debt sustainability and stabilizing it is nominal GDP growth. But if India can grow at 10% nominal GDP for the next 4 or 5 years, even if the pace of consolidation is gradual, debt to GDP will stabilize and gradually come down. So I would say, yes, we do need some consolidation, given starting points, but that should be about 0.5%, and we should not overdo it in the near term.
Mr. Chinoy, do you also see a shift in spending priorities by this government, keeping in mind the political economy constraints and also the nature of the Modi government budget so far?
So I think the spending priorities were quite clear over the last 2 years because the revealed preference of the central government was a big push on infrastructure. And we saw that 0.5% of GDP increase in capital expenditure in FY21. Now, FY22, the targets were more aggressive, and I think it'll be important to step up CapEx in the last 3 months of the fiscal year to try and meet those targets. But I would argue that that sent a clear signal that infrastructure provision with its job implications is the approach the government will go down post-pandemic. I think that's the right one. We've spoken a lot about jobs. So I would hope to see that there's enough space in the budget, both for physical infrastructure, but also for health and education, that these are investments with large multiplier effects. This is where I think the focus needs to be, and I would expect to see it given the evidence of at least the physical infrastructure push over the last 2 years. Now, as I said, this will be a delicate balancing act. The good news is we had a big pickup in gross tax to GDP this year because of the formalization of the economy. So the hope is that tax buoyancy will sustain into this year. One challenge, of course, is going to be oil prices. If crude prices stay around 90 or rise further, that impinges on fiscal space, both on the revenue side and the subsidy side. So there are many moving parts over here. But I think there was a clear emphasis last year that there would be a big push on capital expenditure financed by asset sales, privatization, asset monetization. And I think that is the right medium-term approach because think of that as being a de facto asset swap on the public sector balance sheet, where one is disinvesting or selling less productive assets, but using those resources to invest in health, education, physical infrastructure. So that's what I'll be looking for, that same theme in this year's budget.
Well, tax collections have been a clear winner for this government in this year. We have seen robust tax collection. Keeping that in mind, do you also see the middle class getting some kind of a relief in this upcoming budget?
I think the structural readjustment that's needed is to, again, think about reforming the direct tax code, right? And I think a broader rethink on the DTC is warranted. One where, we can do away with a variety of exemptions, which are sometimes distorting, such that revenue neutral rates can be brought down. I think that would be the healthiest way to rationalize rates, broaden the base, and remove distortionary exemptions. I'm not sure this is the year to undertake large relative tax changes given the macroeconomic uncertainty. But I think if the government can lay out a roadmap for implementation of DTC in the coming years, and we can also, hopefully, the center and the states over time can begin to simplify, rationalize the GST. I think that should set the pace for hopefully higher tax to GDP in the coming years. Because, Siddharth, the central challenge is going to be in the next 4 or 5 years, to the extent that we want the government to keep public investment high. But at the same time, we have to bring fiscal deficits down, by 2.5, 3 percentage points. The only way you can simultaneously achieve both those objectives, higher public investment, health allocation, education allocation, while bringing the deficit down, is to get some buoyancy on the revenue side. I think in the very near term, that can be achieved through asset sales, asset monetization, privatization. But in the medium term, it will have to be increasing the tax to GDP ratio, which will involve both reforming the DTC and refining the GST.
Well, thank you so much, Mr. Shenoy, for sharing all these wonderful insights with all of us. We are keeping our fingers crossed and hope to see the best for the economy in this upcoming Union Budget 2022.
If you like the video, do like, comment, share and subscribe.